SCHD ETF review. Is it still worth buying in 2026? SCHD has become one of the most popular dividend ETFs on YouTube. But popularity does not automatically make something a good investment. In this 10-minute deep dive, we ask, is SCHD still worth buying in 2026? Let's break it down. To understand where SCHD is going, we must look at why investors seek refuge here in the first place. SCHD is attractive because it promises something most investors want: income, quality, and long-term compounding. Instead of chasing the hottest growth stock, SCHD gives investors exposure to companies with a history of paying and growing dividends. That matters because dividend growth can create a powerful long-term effect. You are not just looking for income today. You are looking for income that can grow over time. This is the difference between a static payout and an evolving wealth system. A lot of beginner investors chase high yield. That can be dangerous. It is often a trap set by underperforming companies. A high dividend yield can sometimes mean the market expects trouble. The payout may not be safe. The company may be under pressure. The dividend may eventually get cut. Dividend growth investing is different. The goal is not just the biggest payout today. The goal is a reliable stream of income that has the potential to increase year after year. That is why SCHD gets attention. In March 2026, SCHD underwent a major annual reconstitution. This is where the fund's mechanical discipline really shows. The Dow Jones U.S. Dividend 100 Index uses a mechanical four-factor process designed to filter for quality, sustainability, and growth. To be eligible, companies must have a minimum of 10 consecutive years of dividend payments and specific liquidity thresholds. The March 2026 update resulted in 25 new stocks being added. Key introductions included United Health Group at a 4.00% weight. We also saw the addition of Abbott Laboratories at 3.95% and Procter & Gamble at 3.81%. These are massive anchors. But it also removed 22 holdings. Notable exits included Cisco Systems, which previously held a 3.69% allocation. AbbVie was also removed. Energy and materials names like Valero Energy and Halliburton were cut after failing fundamental screens. The 2026 update marked a major pivot. Energy exposure was reduced by approximately 8%, falling from 21% to 16.3%. This was offset by a 4% increase in healthcare and a 3.5% increase in technology allocations, rebalancing the defensive posture. By shedding energy stocks that had run too hot and adding healthcare names with superior ROE, the fund adhered to its discipline. This mechanical discipline isn't perfect. The removal of winners like Cisco, which rose shortly after being cut, highlights the risk. SCHD's performance has been a subject of debate. In 2023 and 2024, the fund struggled to keep pace with the tech rally. When the market is driven by non-dividend paying giants, the Magnificent Seven, defensive sectors like staples and healthcare lag. By early 2026, the trend reversed significantly. Year-to-date returns as of June reached 19.48%, outperforming benchmarks. The TTM dividend yield is 3.23%. Triple that of the S&P 500. This is the payoff for those who built systems instead of chasing heat. Despite short-term volatility, SCHD's 10-year annualized return remains robust at 12.88% with 13.30% return since inception. The fund has achieved 14 consecutive years of dividend growth. Following the 2026 rebalance, the index growth rate improved to 9.28%. Recall the 3-for-1 share split in 2024. It reduced the price per share to increase liquidity, though total value remained unchanged. Cost matters. The 0.06% expense ratio means you pay only $6 for every $10,000 invested. Efficiency is key. SCHD is not a get-rich-quick investment. It is a long-term wealth infrastructure tool for portfolio stability and planning. Dividend ETFs are not magic. They are exposed to market cycles, interest rates, and investor sentiment. They can still go down. The difference is that long-term investors focus on the income stream and the recovery path, not just the daily price movement. So, is SCHD still worth buying in 2026? For the right investor, the answer is grounded in their specific long-term goals. It makes sense for those who want long-term dividend growth, quality exposure, and a simpler, lower-maintenance portfolio structure. But it may not make sense for someone chasing fast returns or massive growth. It is a tool for builders, not speculators. The right question is not, is SCHD good? The better question is, what role does SCHD play in my wealth-building system? In the institutional world, we look for the certainty stack, clean data trails, explainable logic, and governance discipline. As of June 2026, Qualcomm stands as the top holding at 6.74%, followed closely by Texas Instruments at nearly 6%. United Health Group holds a 5.07% weight. These companies represent the intersection of quality cash flow and dividend sustainability. Morningstar maintains high confidence in the Charles Schwab passive management team, reflecting confidence in their rules-based execution. An often overlooked factor is tax efficiency. SCHD focuses on companies that pay qualified dividends, which are taxed at lower rates. This tax advantage, when compounded over 20 years, can significantly increase your after-tax total return compared to bond interest. We must also address the rigidity of the rules. The mechanical nature of the index means it cannot adjust for forward-looking risks. It only looks at historical data. If a sector enters a fundamental decline, the fund may hold on until the next annual reconstitution. However, dividend growth acts as a powerful hedge against inflation. While bonds pay a fixed coupon, companies can raise payouts. SCHD's 10-year dividend, CAGR, of 10.43% has significantly outpaced inflation, preserving the purchasing power of your income. As we look toward the end of the decade, SCHD remains a cornerstone for those building institutional-grade dividend systems. The 2026 refresh moved the fund back toward a balanced defensive posture, adhering to its buy low, sell high discipline. The fund is built for consistency, not outperformance in every bull market. It is a reliable stream, not a speculative flood. If the goal is fast speculation, it is not the right tool. For the right investor, it fits into a much bigger wealth-building strategy. Only buy if you understand what it is not, and how it fits. Build for the long term. Build for certainty. Do not chase yield. Build systems. Understanding how the system works is the first step to using it. Subscribe to Legacy Tactics for more breakdowns on dividends, markets, inflation, and long-term wealth. This content is for educational and informational purposes only and does not constitute financial, investment, legal, or regulatory advice. Who approved the action? What policy applied? Where is the audit trail? Governance is the foundation of trust. Subscribe for governed AI demos, approval workflows, and enterprise-ready systems that help teams use AI with accountability. Codex Dominion, operational infrastructure for governed execution. Thank you for watching.